to the big market voice this morning, as we always get you one at this time of the show. Kenneth Andrade joins in to discuss his market view. Kenneth, it's great to have you on the show. Thanks very much for taking out the time. So great to have you today. And it's an interesting time actually to have you because there's so much to discuss. I'll start off with just your broad odd market outlook. I know that there's much advice that you can give on stock picking even in a tough market environment like this where volatility is coming back and there's a bit of uncertainty on the horizon. But first, just an overview of how you're viewing the markets at the current levels in the global market context and in the context of the recent scam that's been unveiled in the PSU banking space, particularly to do with PNB.
Okay. I mean, I think we just need to refocus back on the way the numbers are actually panning out. There is a lot of things happening on as far as the macros are concerned. But if you just look on the underlying micro environment and take a look at the quarterly numbers, there are not too many disappointments at all. Okay, and I think that's probably what we should be expecting going into the next couple of quarters also. I think the worst of the bad news is already there as far as the environment is concerned, and we need to focus on the fact that the quarterly numbers are good, and for the remainder part of the year, these should maintain itself. The balance sheets and even in the near term and the longer term, if I just switch the conversation back to balance sheets of corporate India, I think you're going to buy one of the best balance sheets of corporate India going into the next couple of years. Yes, we do have issues as far as the financials are concerned, and that's most specifically contained to one part of the entire environment, which is the public sector companies. But we know the size of the or we could guesstimate the size of the non-performing assets that are there, and all we need to do is find a solution for that. So that will eventually wind itself down. But apart from just that part of the corporate sector, I think the rest of them are pretty much ongoing. As far as the global macro environment is concerned, I think the volatility is here to stay this year. Quite clearly, the biggest dampener to equity investing today is valuations, and valuations are stiff. Valuations will continue to hold on to these numbers only if earnings actually rebound, and that takes us back to the focus back to earnings. And if earnings hold on to the growth that they've displayed in this year, I think the environment should be quite good for equity investing into the next couple of years.
Right. So then let's talk about the opportunities that you foresee, Kenneth, in this sort of a market environment. Taking a leap from what you just mentioned, that actually the earnings picture in Q3 didn't look that bad. There were more numbers in line. There were a few which were definitely outperforming. But largely the sense that you got was things were on the mend. In that sort of a backdrop, where do you see the opportunity from a risk-reward perspective emerging in the market? Because in last year's rally, financials, consumer names, autos, they've pretty much run ahead of course. The only one on a relative basis that looks more attractive, or the only few spaces on a relative basis that look more attractive, are IT, pharma, and infrastructure. So where do you go about finding value in this market, and how do you propose to make investments?
You need to look at the breadth of the market. Like I said, the biggest dampener for equity investing today remains valuations, and valuations will continue to remain stiff. If the news as far as corporate earnings continue to come in, I think it will continue to hold on to those valuations. Here you'll have to segregate between companies that are actually got capacity on the ground and expanding and are growing in line with demand, which is equivalent to GDP growth or a little higher than that. So you've got an environment where corporate India's capacity utilization is somewhere in the region of about 70%. And every time you stress, and every year you go into or every year that progresses itself, you add another 5% to GDP growth or 6% to GDP growth, and that should increase capacity utilization. So as long as there's no supply side coming in, and that's what we see from corporate India. There's no new projects, or there's no large scale projects that are really there on the anvil. As long as supply is constrained, demand is continuous, and that's going to add back to significant amount of leverage, operating leverage that you have on balance sheets. I think the key to all of this is big businesses that have incurred capital expenditure, businesses that have that are low on financial leverage, and just run with them. And they're not coming from one or two sectors. I think the breadth of the market is completely open out there. So the challenges in a market like this is, how do you pick growth, and if you're trying to pick growth, at what valuations are you willing to pay for that? I think those are the two challenges that are there in the environment, but there is enough of capacity on the ground. There's no financial risk compared to what we saw about 5 years down. Investing today doesn't have any financial risk because no companies on the ground are really leveraged. So we just have to put this together. For most investors, they have to put together a portfolio of 20 companies, or probably 25 companies, and that's all you need to run with it. So it's a fairly large spectrum of businesses that are doing well. We just need to find a couple of them that are growing faster, and I can't possibly think about one industry which is not one domestic industry. Exports do have their challenge when it comes to pharmaceuticals and some part of IT, but the domestic businesses don't really have that kind of a challenge in terms of growing profitability.
So Kenneth, where is it that you're finding value right now, where all the parameters that you mentioned match up in some way or the other?
I think if you turn yourself to utilities, that industry is relatively in distress. So there are a couple of businesses out there that you find merit in that. I think I've been speaking of media for some period of time right now, but you're finding traction in a couple of companies already that are showing reasonable growth in both top line as well as profitability. You turn over to some part of the agri value chain. Their valuations are already there. What is required as far as that part of the entire market is, where will growth actually come from? The macros are conducive. We'll need to see how it actually plays out over the next couple of quarters. Like I said, this space is a little expensive compared to where it used to be about 2 years back. If you go into the automobile basket, the auto businesses, I think commercial vehicles haven't done anything for a long period of time, and there are just a couple of companies out there that you could align with. That's another part of the business that we're doing. Even within the consumer space, I think you will find opportunities out there. So these are places that I think are showing relevant growth in top line or in turnover. Bottom line will get magnified going into the next as capacities continue to get utilized. Okay, one space that we've navigated through, or we haven't participated yet, is financials. I think the asset side of the entire economy is doing relatively better than probably the companies that actually fund it. So we clearly stayed away from that part of the market for now.
Okay, and is that a strategy that you would continue to follow? Or are you tempted to jump into any of these financial names?
And no, I think we're pretty comfortable in the spaces that we have.
To hear that.
No, just as a follow-up to Aisha's question, Kenneth, does it mean that it's really all bets off the table, even for some of the large cap private banking names which have actually delivered good returns, and consistent returns are compounding stories. I mean, if you're saying that you're off financials, somebody who's watching you would be like, but why would he not invest in an HDFC Bank or a Kotak Bank or an IndusInd Bank where the numbers have looked good? And some of the housing finance companies where the rally has been strong. I understand your whole logic behind, the asset liability mismatch, but there are definitely some bright spots, so to keep away from financials, do you think would be a prudent strategy in this sort of a market environment? Because if the economy comes back, financials will be core to that recovery.
It's worked for us the last year and a half, and I don't see any reason why it can't be in continuation. But we've been holding on to the premise that we've been holding on to the premise that we're looking at the value at companies that offer a reasonable amount of value and have enough capacity on the ground to actually leverage it into the economy. We find a lot of them in manufacturing. And currently, from the format that we work on in terms of advisory and portfolio management, we don't necessarily need to be across all industries. So we as a manager, we basically pick 2 or 3 spaces and we go there and dominate those particular industries. I think that's the format that we adapt. And financials really don't fit into that entire market. Now, we got to distinguish between good companies and good stocks. Okay, I'm not saying that these are not good companies. Like you did mention, there are a couple of names that have been compounding stories over long periods of time. I should have been in that trend, but I should have been in that trend going into 2017 and 2018. And I have participated in my previous careers in some of these names that have been there. But currently, I think where valuations stand and from your return expectations, I think a lot of it is already priced in. I would not know how to make significant amount of more money out of these out of the basket of these companies. A few companies will definitely be there that will generate reasonable amount of upside. But the format that we operate in. I mean, we can choose to stay out of these names, and we're happy to do that. And it's worked for us in the last couple of months.
Morning, Nikun's also joining in from the Delhi studio. Now, Kenneth, the way you approach your portfolio is that you like to pick up small niche businesses, not popular but yet very decent mid and small cap stocks. Do you think it will be difficult for the small and the mid cap category now to remain an outperforming category? I mean, in 2016 and 17, it was the game of tic-tac-toe. You bought any small and mid cap stocks and they did better than large cap stocks. Do you think that wave is now behind us?
I think the divergence is already showing up there, and it's been showing up for the last year and a half. So any company that's not been able to deliver the quantitative numbers have not been actually participating in the market. So I don't think that trend will break. So we're clearly not in a valuation-driven market anymore. We're clearly in a very growth-driven market, and we necessarily need to find opportunities that will continue to expand themselves. So going forward, I'm not too worried about the space that we occupy, which is small niches and companies that are relatively and companies which are mid-capish in nature. I think you'll still find opportunities. You'll still find industries at the bottom end of their entire industry cycle. And timing these things are always fraught with risk. But any industry at the bottom end of its economic cycle gives you enough opportunity to pick companies within that entire space itself. So that's where we are, and we find reasonable amount of space to occupy out there.
To your favorites, which is the Coromandel fertilizer and Kaveri seeds, or that's passe now?
Like I did mention, that entire agri value chain is not as cheap as it used to be about 18 months back. Okay, and we just have to wait for growth to actually kick in that space. The macros are good for these companies. We'll have to see how they play into the environment and increase volumes out there. So the challenges continue to remain. Markets are fairly well priced.
You bought liquor stocks in the past, and now liquor stocks, at least there is evidence of earnings recovery and there is evidence of demand stabilization. Is it time to revisit some of these good old liquor names?
Well, the worst in terms of news and bad news is behind them. So I guess that means that they can go back to concentrating on growing the business and markets, and less on how the environment or how uh, fra- uh, the environment actually works for them. So it's all about growing the business for me. I think they understand that, and they're running with it.
Ken, it's such a pleasure chatting with you today. Thanks so much for taking the time out and speaking with us.